From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, inflation, the hottest since 1982, teeing up the Federal Reserve's next move as investors consider rate hike bets. We begin with the big issue. Over to you, Chair Powell.
The inflation print,
does it change things materially?
It probably doesn't.
It is pushing the Fed to accelerate tapering next week.
This inflation problem,
It just keeps pressure on the Federal Reserve.
The risk is to a much faster tightening.
Even if they double, the market is still looking at 200 billion of liquidity injections.
That is something that the Fed is still going to have to grapple with.
they're not doing anything that's going to disrupt the liquidity.
One of the dangers, which I think the Fed continues to neglect,
Real rates, as stated, are still very low.
that's really the issue here for the Fed.
The Fed doesn't damage the market by raising interest rates.
The Fed is really at an important transition point.
They damage it when they invert the yield curve.
It's really going to come down to whether or not they continue to see inflation remain sticky.
Joining us now, I'm pleased to say, is BlackRock's Jim Keenan and Zach Griffiths of Wells Fargo. Lisa Shalett of Morgan Stanley is going to be joining us a little bit later in the hour. Gents, we've got the data, the economic data, and a bit of data on Omicron I want to share with you as well. The CDC reporting initial findings on the variant. 79% of the first 43 cases are in fully vaccinated people. Mild illness in fully vaccinated, just mild illness. One vaccinated person hospitalized for 2 days, no deaths. So a bit of information here at the moment, gents, to tee us up for next week. Can we just start with the inflation data? First to you, Zach. What you think this means at the moment at 6.8% in America?
Certainly very hot inflation, John, and really in line with our colleagues in economics expectations. And I don't think the data today really changes anything for the Fed. They've made it pretty clear that they are willing to accelerate the pace of taper. Our colleagues in economics look for them to increase the taper to 15 billion in treasuries and 7.5 billion in MBS. I think that's probably a little bit less than the market is expecting. But inflation is hot. The Fed has made it clear that they need to act. And I think what they're doing is really giving themselves the option to hike faster in 2022 should the data support that move.
Jim Keenan, can I get your reaction as well to the inflation data, and then we can talk about what it means for the Fed further down the line?
No, I agree with Zach. I don't think this changes much in the near term with regards to what the Fed policy is here. Clearly, they are starting to act as you see. Liquidity conditions are very robust, but you are seeing, a lot of that inflation flow through the system in different cohorts, right? You're seeing labor inflation, you are seeing goods inflation, and obviously some of the supply and manufacturing inflation that we've seen. We expect those to have a different duration to them. And I think, the Fed is going to be a little bit patient with regards to labor inflation if goods inflation starts to come down over the next couple of quarters. But I don't think it changes much with regards to the near term. It's right for the Fed to start to shift its policy a little bit as both inflation and labor start to get a little tighter.
Jim, walk me through the shift that you're looking for. I hear from a lot of people that it goes something like this. You taper aggressively, then you start thinking about rate hikes somewhere in between. Now I hear people this week starting to talk about balance sheet reduction, perhaps before an interest rate hike. Jim, how do you think about the sequencing at the Fed? What do you think drives one or the other?
Yeah, I actually don't think that they're going to start to shift the balance sheet. They may look at different measures in order to start to reduce some of the liquidity in the system. But I think that sequencing of taper is the initial part. I think they'll balance the Fed hikes with regards to some of the data that we'll see in 2022. I think probably the most important thing is just thinking about this Fed has become a little bit more data dependent, right? We've moved away from some of the extreme measures that they needed to manage the crisis that we saw in 2020 during the pandemic. We're in a very different state with regards to the pandemic and the vaccines. Obviously, there's going to be a lot of volatility with variants. But I think they will continue to be data dependent, and that's going to be both growth as well as growth and what is going to happen with variants like Omicron and how that may impact growth in 2022.
Zach, can I get your thoughts on that as well, please, just in terms of the sequencing? What drives one part of that sequence and how you think it lines up?
Yeah, we don't think that balance sheet reduction is really on the table for a good couple years, if it's on the table at all. And if you think about the last time that the Fed reduced its balance sheet, it didn't end very well with the September 2019 blowout in repo, and I think they've taken some measures to reduce the possibility of that happening again. But overall, we sort of see the risk-reward of reducing the balance sheet as imbalanced toward the risk side, and we think the Fed will probably avoid that until well after it's begun its hiking cycle and perhaps even longer.
Lisa Shalett joining us now from Morgan Stanley as well. Lisa, great to have you with us on the program. Just talking about inflation, CPI coming in at 6.8% in line and what that means for the Federal Reserve. What's your read on that, Lisa?
Yeah, so look, our guess is that this is not a new data point at all. We were expecting a big number. We got it. It came in right at the consensus estimate of 6.8%. I think our concern at the minute is less about the fact that the Fed is now likely to accelerate taper and bring, forward the hikes in line with what has been discounted in the market already, and more about what's going on with the shape of the yield curve and the terminal rate. So one of the things that appears to be discounted, and given the current shape of the curve, is this idea that the Fed remains behind the curve, and that they're going to have to not only start hiking sooner, but once they do so at a rapid pace, and that rapid pace, then undermines the cycle, which is why your 10-year yield is kind of anchored down there at 1.5%. And you've got a terminal rate that's about at the same level. That's where we think, there are going to be some surprises. We actually don't think that the Fed will ultimately end up being as hawkish as what is currently priced, and that while they may do 1 or 2 hikes next year, the data on inflation is going to moderate pretty quickly as we get into the second half.
Jim, I'd love to come to you on that and pick up on some of what Lisa said. We're at 65 basis points on twos. We're down 4 basis points. To what extent is this market actually priced as hawkishly as some people think?
Yeah, it's definitely right. I mean, Lisa touched on it. The expectations or the fears of data points that we're going to accelerate the Fed and the tightening cycle has certainly been in the market, right? That is priced into assets. You can see that across not just the rate market, but also in different parts of the equity market and spread curve. But at the end of the day, I agree. We are already starting to see some moderation of some of the inflation pressures that you've seen on the supply and transportation elements. We do expect things like rent and housing to start to pick up into 2022. But again, that balance is going to be important. I think, as the market is going to have to digest that news, the interplay between the expectations of both growth and inflation and what the Fed may do is going to create a lot more volatility around risk premium. So I don't think it's actually going to change the economic volatility or earnings. I actually think the foundation for that is very strong. But I think the markets will continue to debate this, and you'll see a lot more volatility around risk premiums into 2022.
Zach, what are we priced for? Just the reaction to this inflation data. Yields down 3 basis points, 10s at 147, 2s at 65. What's your read on that? A rally off the back of a number that comes in line. Does that tell you that this market was already primed for some hot inflation?
It definitely seems that way. And when you think about the inflation print relative to economic expectations, it was really right in line, if not a little bit stronger, but the market seemed to expect a lot more. So what we take away from this is that inflation is hot. We expect it to remain hot through the first quarter of next year. And as far as the Fed's reaction function goes, we do think that an accelerated taper is in the cards next week, but we think the Fed is going to be slow to hike rates. And you see markets priced for the possibility of a rate hike in March. We think that's too early. We think June even is too early. So we look for 2 hikes next year, and that's consistent with a Fed that is looking to remove accommodation, but remove it slowly, as some of the issues the economy is facing now is not well suited for the Fed to deal with its traditional monetary policy tools. That
call for 2 hikes also consistent with Morgan Stanley now too. Ellen Zentner leading the way, looking for a hike in September next year, in December again to make it 2, and then a further few more in 23. Lisa, I want to come to you on that, not on the rate hikes, just on this market at the moment, and your thoughts on what we're actually priced for. You talked about a hawkish pricing in this market, but I see 2s down at 65. I see a front end that's not built up that much.
Yeah, no. So look, I think what we're anticipating is that the twos maybe come in a little bit more, and we get some steepening in the curve, because I think that what we're going to see is a Fed who is not just focused on inflation, but let's remember they're after this idea of quote unquote maximum employment, and so I think that there are incentives to try to extend this cycle, and therefore we're going to hear the word patience again, is our guess, that they're going to want to be patient to wait for that labor force participation rate to get back up, that they're going to try to balance this, and in so doing, that 2-year, Treasury maybe comes in a little bit and settles more around that 45 to 50 basis point range. Maybe suggesting we've got kind of two to three hikes, but it's the 10-year and the longer end of the curve that starts moving up as we discount a longer, stronger cycle, which is kind of in our forecast.
Lisa Shalett sticking with us alongside Jim Keenan and Zach Griffiths. Everyone's sticking with us. Coming up on the programme, up next, the auction block, demand for junk remaining hot. The primary market recording its busiest day in 3 weeks. That conversation up next. This is Bloomberg. From New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with sales of new bonds exceeding estimates and topping 10 billion euros this week. Canada's Bank of Nova Scotia leading the way with the largest euro-denominated covered bond of the year. Pharma giant Merck paving the way in US investment-grade debt sales, pushing weekly volume through estimates while expanding December's record haul above 61 billion. And finally, US junk bond sales springing back to life with 2 debut issuers coming to market, taking a weekly tally to more than $6 billion. Back with us, Lisa Shalett, Jim Keenan and Zach Griffiths. Jim, anything to worry about in credit right now from your standpoint? You're in there every day. What do you see?
Actually, credit is probably the more boring part of the overall markets right now. It's a pretty solid foundation for the credit markets. I would say in the last couple of years, fundamentals have remained strong. You've seen, I would call it general deleveraging that you've seen across the markets as you've seen the recovery in earnings post the pandemic. I think as you look into next year, really solid foundation from the demand side of the equation, both at the household level and business investment as they start to compete. You'll see a little bit of volatility, but I think dispersion is probably the biggest story, and that's volatility be caused by some of the cost inflation that you see in some of the sectors that will hurt some sectors and benefit others. But at the end of the day, fundamentals look very strong, and as long as you have a solid, stable growth profile, as well as a good earnings picture next year, there's a pretty solid foundation for credit. Returns are going to be much tighter next year just because of the valuations coming in. So we're expecting a low, mid-single digits type return across the leveraged loans and high yield markets.
Zach, do you agree? Boring's good, isn't it?
Boring is good, and we think things could get a little bit more interesting into 2022. Our colleagues in credit strategy are calling for spreads to widen a bit, and the backdrop for that is tightening monetary policy, at least on a relative basis. But at the end of the day, our economic forecast remains strong. We look for economic growth of 4.4% in 2022. So while we could see some spread widening, and I think increased volatility really across markets is probably in store in 2022, the underlying economic fundamentals are strong, and that's going to remain the case really through 2023 in our view.
Does tapering make a difference? This was coming from Mike Wilson of Morgan Stanley. He said the following: tapering is tightening for the markets and it will lead to lower valuations like it always does at this stage of any recovery. Lisa, I know you work closely with Mike Wilson as well. Can you just get me your thoughts on that? Does tapering actually matter to risk assets? Because so far, not much at all.
Yeah, so look, our perspective is that liquidity in the market absolutely matters. While we're not yet at the point of reducing the size of the balance sheet, the reality is that there is less liquidity being injected, and so our sense is that you're going to start seeing some pressure on valuation multiples. You're going to start seeing some pressure on cost of capital and on rates. And it's just a question of timing, right? I think at the end of the day, we've seen this playbook before to a certain extent. I think, the experience of 2018, 2019 has certainly prepared markets to a certain extent. But we've also had a certain level of market resilience that I think has been unexpected. And that's really the last leg where we think, all stocks in the market need to discount the reality of what's going on. And we think that we're going to see that in the first quarter.
Jim, what is it I should worry about, the tapering or the balance sheet reduction? What's the difference between the two, and do you think we actually get the latter?
Yeah, I don't think it's as important to try to figure out the taper versus the balance sheet when you think about the aggregate direction of asset prices. I think, when you look at it is how much liquidity is in the market, and Lisa touched on this before. It is obviously we could spend the whole show debating with what we think the Fed should do, but clearly it's a more complex environment as you start to mature in the growth profile coming out of the pandemic. So I think the markets are going to continue to debate what the Fed should do or what central bank policy should do globally relative to the inflation print or the direction of rates or growth. And so I think that's going to create some volatility, and risk premiums should go up because the range of outcomes are going to be a little bit more broad and the risk to the downside if whether it's taper or balance sheet reduction, which we don't think is on the table, but other measures that are going to tighten liquidity is going to accelerate the end of the business cycle. That is going to be a bigger risk and to both earnings projections as well as the risk premiums that you would put on that. So I think that's going to play out over the course of the year. You're going to see volatility spikes. I don't think, again, it changes the direction. I think earnings actually would be pretty stable, but the market volatility and the dispersion between different industries is going to be pretty broad. And I think that's a pretty good alpha opportunity next year.
Zach, final word to you, sir.
Yeah, I think the point on liquidity is a big one, and it even makes sense for our rates call when you think about the Fed reducing its asset purchases. I think that's going to have a bigger impact on the TIPS market, and that's why we think real yields are going to rise in 2022, and that's a big part of our call for why we do think long-term yields are going to rise, but less so than front-end yields.
Zach, Jim, Lisa, sticking with us. Still ahead, the final spread, the week ahead, featuring rate decisions from the world's biggest central banks. Their conversation just around the corner from New York. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, US PPI and retail sales. Coming on Tuesday and Wednesday, plus the host of central bank rate decisions with the Fed, the ECB, the Bank of England, and the Bank of Japan, all with policy decisions throughout the week. For a final word, it's Lisa Shalett, Jim Keenan, and Zach Griffiths. Lisa, I want to come to you. We've talked so much about the Federal Reserve. Can I get your thoughts on the rest of DM right now? The ECB, the Bank of England, the kind of moves that you're looking for?
So look, I think in developed markets, they are going to continue to go slow. And that's, one of the issues that may be underappreciated is the extent to which US dollar strength in the short term is going to continue to assert itself. And that in and of itself will be a deflationary force. Given the role in consumer imports of currency prices, that strong dollar is really going to help bring that CPI under control. And this relative dispersion in central bank policies is at the root of that.
Dollar already pretty strong, Jim. Do you think that can make a difference next year? Dollar index just short of 96.
I think it's, I agree with Lisa. I think the trend will continue to be higher. I mean, again, that goes more into the strength and stability of the U.S. growth profile. And so I think that will continue to lead into both the perception of the direction of travel for both policy at the Fed, as well as continue to provide some support on the dollar side. I don't think it makes that big of a difference if it stays kind of stable in that direction with regards to the underlying asset prices across spread or equities.
Zach, have you got a view on the ECB, a call on the ECB next week?
Yeah, John, we're looking for the ECB to end its pandemic emergency program, but we expect them to offset that by boosting their regular asset purchase program. So I think the key takeaway of what we're looking for is the ECB is going to move very slowly and much slower than we expect the Fed. And we think that's probably a theme for the Bank of Japan too. And that is one of the key reasons that we expect the US dollar to continue appreciating in 2022. But that's really baked into our forecast, and we expect inflation to remain elevated even on the back of modest USD upside in the near term.
Not expecting the moves that we had from Brazil this week, a 150 basis point move in one single meeting again, and teeing up potentially the same again next year in February, maybe another 150 basis points to come from then. EM this year have made some massive moves. Next week is all about developed markets. As we keep saying, the Federal Reserve is on Wednesday. Then on the Thursday, the Bank of England and the ECB. Guys, before we go, I wanted to get to the rapid fire round. 3 quick questions and 3 quick answers if we can. Let's start with this one, an easy one. Faster taper announced next week. Just a quick yes or no. Do we get a faster taper announced next week? Yes or no? Jim?
Yes.
Lisa?
Yes.
Zach?
Yes.
That was easy. A hawkish surprise or a dovish surprise? The reason I asked this question for next week, we had Bill Dudley on the show earlier this week talking up a big shift higher in the 24 dot from 180 to 250. Are you positioning, thinking more about a hawkish surprise or a dovish surprise next week from the Fed chair? Jim?
Dovish relative to expectations.
Zach?
Dovish.
Lisa?
Dovish.
And a final question for all of you. I keep throwing this one out there. Rate hikes next year, 1, 2, 3 or more. 1, 2, 3 or more. Lisa?
2.
Zach?
2.
Final word, Jim Keenan.
2.
Jim Keenan, Lisa Shalett, Zach Griffiths. That was easy as well at the end, wasn't it? 2 all round from New York City for our audience worldwide. We will see you the same time, the same place next week. This was Bloomberg Real Yield, my final one for the year, actually. I'll see you in 2022 on this one. From New York City, this is Bloomberg.